your interpreter. For those of you who are not bilingual in English and Spanish, we do have interpretation available. So if you're joining us through a PC or laptop, you'll see a globe icon appear momentarily. It's going to be at the bottom right hand of the screen. You'll click on the globe and select Spanish. If you're joining us on a phone or tablet, you'll click the three-dot menu, select More, select Language Interpretation, and again, English or Spanish. We'd like to remind our speakers to please speak at a moderate pace. And if the host can assign me now.
So what?
So go ahead and click on the icon, on the globe icon.
Yep.
And
Added interpreter.
Add interpreter.
You should be added now. So
not yet.
Okay, how about start there? Okay. Lena, I'm assuming that that all is working. I'm going to get started with this. Okay, great. Good afternoon, everybody. My name is Nikki Parr. I am the COO here at Women's Economic Ventures at WEVE. And I'd like to welcome you all to this webinar that is being put on in collaboration with the UCSB Economic Forecast Project and also with the EDC. We're living in interesting times, and business owners, especially those in this region, need to have an extra dose of resiliency to navigate the ups and downs of being an entrepreneur. After wildfires, floods, and pandemic, we are now impacted by high inflation and interest rates, and the constant mutterings of a recession. So here to provide some guidance, insight, and reassurance to support you tenacious entrepreneurs, I'm today joined by Peter Rupert, the Executive Director of the Economic Forecast Project based out of UCSB, which provides local community with relevant economic data and business trends. Peter's going to give us his Cliff Notes version on the ever-changing economic outlook and really what this means for local business owners. After Peter, we're going to hear from two of my colleagues from our partner organization, the Economic Development Collaborative, or EDC, which, much like WEVE, provides advising and funding to small businesses. Ray Bowman, the director of their Small Business Development Center, will speak to the opportunities that can exist for business owners during times of economic uncertainty. And business advisor Gonzalo Fernandez will provide some practical guidance around what business owners should be considering during times like these. I will ask you to hold your questions until the end. There will be time for a Q&A at the end. You can put them into the Q&A box and we'll put them in then and speak to them then. And we'll also share more information about the services that WEVE and the EDC provides. So without further ado, Peter, over to you to give us an overview of where things are at.
Come on, here we go. Okay, can everyone see that? Great. Okay, well, thank you very much. Happy to be here. As Nikki pointed out, I have lots of slides here, and some of them are backup slides. So, I'll have this posted. Nikki can post it on the WEVE site, and if people want to go back and take a look, that's great. So I'm professor of economics at University of California, Santa Barbara. Also the director of the UCSB Economic Forecast Project. And you can see the initials WEV. I have my own initials. And, basically, so WTF, people have it misinterpreted. Everyone knows that means what's the forecast. And so what I'm going to do today is, I run the forecast project, but I don't forecast. And we'll probably tell you why later. But I'm going to give you just a little bit about what's going on, in the economy. And what it means for for local businesses, et cetera. So without further ado, we really have to know where we are today before we can think about what to do in the future. And so I will try to present a little bit about that. As everybody probably knows, the most noteworthy things, and Nikki mentioned it, is basically that we're in the midst of kind of the highest inflation we've seen in a while, no doubt about that. Constant talk of recession, that's been in the news just repeatedly. And of course, just recently bank failures, which is obviously, very meaningful for many of you out there. And, let me just say that, there are many, many banks who took some risks. Not all banks are like that. And overall, the banking system is pretty sound, especially many of our local banks, community banks especially. And, we can all talk about that later. So you might have seen, if you were up to the minute reporting, the Fed raised the interest rate again by 25 basis points about an hour ago. They announced it. So what that basically means is many, many interest rates end up being tied to what the Fed does. And as you know, the Fed has been raising the interest rate more than it has, in the last, 30 or 40 years, how fast they raised rates. And of course, there's lots of other things that are out there that we have to worry about, that are, figuring into what the Fed does, what the economy does. Obviously, the wars, the pandemic is finally sort of in retreat. And remote work, that's something I think that many of businesses, really have to come to grips with. We don't know where we're going to be with that. Many businesses say they're going to stay the way they are, very remote. Others want their employees to come back into the office. So that's going to be a tough one. Only time will tell what's going to happen there. Okay, so let me just start out with inflation. And, the idea of inflation, the measurement comes from the Bureau of Labor Statistics. And the whole idea is it's really the overall general, and I underline general, because many people say, a particular price rises, that's inflationary. That's not what inflation is, and that's not what is measured in the data. It's really about a big basket, or all goods in the consumption basket. And we want to get a sense of how that's moving. And so many of you are aware that, the typical measure that you hear about is the CPI, the Consumer Price Index. That's what we call a cost of living index. And that's the stuff that's in our market basket that we typically buy. Okay, and when we think about that, it basically tells us, on average, how are the prices moving? Well, the big question is, at what frequency should this be reported? Now, that might seem like not a big deal, but do we report the monthly one? That comes out once in a while. The year over year comes out a lot. So let me just show you an ugly picture. I purposely made it ugly. I'm sorry about that. But the idea is this. This gold line is the one that typically gets reported. That's the year over year rate of inflation. However, the BLS measures it monthly. That's this blue line. And you can see the difference between the monthly and the year over year inflation rates. The year over year is much, much smoother, whereas the monthly one, the blue line, is very, what's a good economics term? Wiggly. It's very wiggly, right? So the idea is that both of these things are providing information, but what we really want to know is, what's the general trend in that? And so what I've done is, if you see these sort of middle three that are here, whoops, doing that. These middle three that are here, basically what those are is a 3-month and 4-month and 6-month, where I've just looked at the average over those months. And what you can see is they've fallen over 2022. They've been falling. They've kind of leveled out. So inflation is not declining, even though if you looked at the year over year, this one, it looks like it keeps declining. But it's because it's slow to react because of the year over year nature. The point is, inflation is down from its peak up here, but certainly now it's pretty much flattened out. And I'll explain why that's important in a second. So you might have heard about, where this is coming from. The Federal Reserve for a long time was saying it was supply chain issues. My view is they were completely wrong. It wasn't supply chain issues at all. What I mentioned about the general price level is some prices were rising, some prices were falling. So that really didn't lead to inflation. What really led to inflation, in my view, and many others, is that it had to do with expansive fiscal and monetary policies. For example, going back to the Great Recession and afterwards, lots of stimulus money, the pandemic, et cetera, the Federal Reserve and the Treasury worked lots to pump a lot of liquidity into the system. Now you say, you know, maybe that's not of interest to all of us, but you know, the way it works is our economy is now in the highest debt level we've ever been to since 1939. Way higher even than World War II. Okay, so we're in an astounding amount of debt, and at some point that has to get paid back. Okay, which means that in the future, you know, taxes are going to have to rise, et cetera, et cetera. So this is nothing that's really on the current horizon, but you can expect that that's going to happen. And you can see that back in the 70s and 80s, we had the lowest debt we've ever had. Okay, so we can get back there. It's going to take a long time. And to do so, government's going to have to cut some spending. Taxes are probably going to have to rise, et cetera. Okay, this is the Fed balance sheet. I'm going to explain this in a second. But in the early days of the Fed, they were about $800 billion central bank. And this blue that you see here, that's nothing more than the traditional short-term treasuries that the Fed has always held. During the Great Recession, which started in 2008, the Fed had to lend a lot of money. They didn't have enough treasuries to do what they needed to do. So the Fed started buying long-term treasuries, mortgage-backed securities. Those were bad debts of banks, and continued to do that. And now you can see the Fed went from an $800 billion central bank to a $9 trillion central bank. The Fed doesn't really want to hold long-term treasuries, nor do they want to hold mortgage-backed securities. So at some point, they're going to have to slowly get rid of these different holdings, you know, that they have. I'll explain why that's important in a second. Historically, the Federal Reserve, has held about 5% of the federal debt. Today, the Federal Reserve holds 25% of the federal debt. So almost 1/4 of the federal debt is held by the Federal Reserve banks. Okay, so why is this important? Well, it's important for the following reason, and you know, it gets debated time and time again, but the only way the Fed can buy mortgage-backed securities or buy treasuries or buy anything is if they print money to do so. The Fed doesn't produce any goods to sell, they print money. Just so you know, it's a really good business to be able to print money. So if you want to get in that business, be careful. So this is why it's important, and this is why it's important to all of us, and I'll explain, especially now, how it's really going to affect many in the low-income quartiles. So what I have here is the blue line is average hourly earnings. So this is average hourly earnings year over year in the US. And you can see, sort of going back right after the Great Recession, that line, you know, the average hourly earnings were growing slowly at about 2% per year. Now, you think that's not very fast. However, we don't necessarily care that much about just those nominal earnings. Why? Because there's inflation. And one thing you can see, the red line, that is the CPI. That's inflation, year over year inflation, as I put up before. So what's the idea? The idea is this. When the blue line is above the red line, that means that real earnings, that is your purchasing power, is rising. That's because your hourly earnings are growing faster than inflation. However, when the red line is above the blue line, that means that your average hourly earnings in real terms, purchasing power, is falling. So even though today you can see that average hourly earnings are growing about 4.5%, inflation was growing at 8%, 6%, which means that every year individuals are losing purchasing power. Why that's important, especially for small business owners, many in the low income sector, minorities, et cetera, inflation affects those groups much more than everybody else. And the reason is they're much more cash intensive. That is, they're not holding many CDs, et cetera, et cetera. Almost all of the consumption is what we call hand to mouth. That is, they don't have large stock of assets that are in growing, for example, long-term CDs or short-term CDs. So that's why it impacts low-income individuals more than high income. And again, you know, if we talk about, again, what the red line above the blue line means is those individuals are getting poorer every year. And it has been happening for about the last couple of years. Okay, so real purchasing power has been falling. That's why the Fed has been so worried about inflation. They realize this problem. That's why they've been increasing the Fed funds rate as fast as they have. I believe they got behind the curve. That's a whole other talk. Okay, so let's talk about recession. Here's an audience participation one. I just want you to think for a second what the definition of recession is. I know what everybody says. Everybody says it's 2 quarters of negative GDP growth. That's what they always think. Of course, that's false. There is no definition of recession. The National Bureau of Economic Research has a team that looks at the data and decides whether we're in a recession, but they go back 6 months and say whether we were in a recession 6 months ago. Okay, so there is no real definition, but people talk a lot about different things going on. And so this is a picture of all the past recessions. So every time you see these gray bars, that's a recession. And you can note a couple interesting things. So if we go back sort of to before 1940, you can see recessions happen much more frequently, and they were much longer. Since the Great Depression, basically, the recessions have been very short in nature and farther apart. This was the Great Recession here. This is the current pandemic. The recession there was just a couple of months long, okay? So recessions are normal, recurring things in the economy. So are we in a recession? I'll give you a little hint to the answer. It's no. Many people think we might be in a recession, and they point to GDP, which I just mentioned, and what's known as the yield curve, which is long-term interest rates versus short-term interest rates. So this is a picture of GDP. Here are the 2 quarters of negative GDP growth. This one, 0.6, that's about rounding error to the federal government. That's a small number. Since then, our real gross domestic product, or our real incomes, have been growing in real terms, 3% a year, pretty close to that on average. Consumption has not ever fallen. Even though our incomes fell, consumption did not fall during that time period. So there's something called the yield curve, and a lot of people make a big deal about the yield curve. And I mentioned before that historically the Fed was buying short-term treasuries. Now they have long-term treasuries, which are this green business. Those are long-term treasuries. What that means is when the Fed buys treasuries, it affects the long-term interest rate. When the Fed buys short-term treasuries, it affects the short-term interest rate. Okay, so now they're in both markets. They used to be in only the short-term market. This is a picture of the yield curve. It's the 10-year treasury, the return on the 10-year treasury minus the 3-month treasury. And what you can indeed see is that many, many times when the yield curve goes below 0, there's a recession. And now we're below it. The question is, you know, does that information coming from this time period when the Fed is starting to buy lots of these treasuries, is it as important? And as everybody has remarked, the economy is actually very, very strong. How is it strong? Well, we're going to look at the labor market, and then we're going to look at household and business finances. It's like a magic trick. I have that to do in 5 minutes. Employment is pretty much close to back, a little bit higher than it was before the Great Recession, before the pandemic, excuse me. But if we had grown as we were growing, we're still a little bit below that where our growth would have been. This is a picture of monthly growth in employment, and you can see it's been relatively strong. The labor market is just on fire. There's no doubt about that. I showed you earnings were going up at 4% a year. That's the first time they have grown that fast in 10 years. Inflation's eroding it, however. This is unemployment, the number of people unemployed. and the number of job vacancies in the US economy. Historically, the blue line, which is the number of unemployed people, was above the number of job vacancies. And in fact, you can see it at the end of 2009 and 10, there were only about 3 million job openings in the US, yet there were 15 million people unemployed. It was really hard to get a job because everyone, there were 5 people searching for each job. Moved to 2018, these lines crossed for the first time, which means there are more job openings than unemployed people. So it's by a large margin. That means that jobs are fairly easy to get for people, yet they're not being filled. And that's a whole other lecture as well. Okay, financial status. During the Great Recession and right before, a huge buildup of debt. Banks, businesses, households were in much more precarious situations. They're in much, much better shape today. As we know, house prices before the Great Recession were growing tremendously fast. This is LA. And you can see they grew by about 2.5 times in like 5 years. That's astounding growth. Guess what? That astounding growth is occurring again right after the pandemic. So if you thought we were in a bubble before, house prices are just gigantic. They've started to cool off. Why? Well, listen, again, here's before the Great Recession. As you can see, housing prices were growing, at 20, 30% a year. That's not sustainable. Anytime you see that, they're going to start to fall. They just can't keep growing that fast. And that's exactly what we're seeing today, this decline in the growth rate in housing prices. This is business debt to equity for the entire US. So what you can see is during the Great Recession, there was a huge buildup of debt relative to equity. And then after the Great Recession, businesses became much, much safer in terms of their debt to equity position. And now it's pretty close to the lowest we've ever seen going back to the 1950s. So generally speaking, businesses are in pretty good shape. These are households. You can see the same pattern, that households during the Great Recession were a lot more leveraged, had a lot more debt compared to their disposable income. Almost in every category, that's fallen. Now, what's the problem today? The problem today is with the Fed raising interest rates, obviously, that means borrowing is very, very difficult for small business. Now, what did the data actually say? So let's not listen to commentators. Let's look at the data. This is a couple people who go out and they get a bunch of data in real terms, not stocks, not house prices, but productivity and output and things like that in real stuff. They have an algorithm that decides whether or not we're in a recession and the probability. I like their model because when we're in a recession, it's 100% that we're in a recession. This is today. The data say that the probability we're in a recession is like 3%. So the real variables in the economy are super, super strong. The Fed, as you know, has been raising interest rates. That's their Fed funds rate. And you can see pretty much the fastest they've ever done it. What that means is that other interest rates are rising too. CD rates are going up, borrowing rates are going up, mortgage rates are going up, as we all know. So here's the mortgage rate. Now about 6%, fallen a little bit in the last couple of months. Nowhere near where my dad had his mortgage at 17% at one time. So that makes it more difficult, obviously, for people to buy homes. So final thoughts. Look, the US remains very strong. Are we in a recession? No. What's my fear? My fear is there's so much talk about recession that if everybody believes we're in a recession, what happens? Well, we don't buy the things we're going to buy. We pull back. We don't go to as many restaurants. We don't buy the new car. What does that mean? It means consumption in the US falls if we think we're in a recession. Well, as consumption falls, it puts us in a recession because that's one of the measures. So in any event, but are we heading towards a recession? That's a really stupid question, right? I just showed you the picture of recessions. If we're not in one, we're heading towards one. There's no doubt about that. Okay, so the point is, we're not in a recession. almost every aspect of the real economy is strong. The banking system remains strong. And anyway, my 20 minutes is up. So thank you very much. I appreciate it.
Thank you, Peter. And actually, just before you disappear, one sort of word of advice for small business owners based on what you just said.
Well, I mean, I think that, people should go through with what they've been thinking about doing, that they shouldn't be pulling back right now. It's not the time. Obviously interest rates are rising, so it makes it more difficult to get loans. We know the credit market has pulled back, but it's really not a time to, to fall backwards and say, we're not going to do the things we planned. The real economy is too strong. And could we be going to recession next month, or, who knows what can happen. But as of right now, like I said, the labor market's strong, and, it's certainly useful just to keep pushing ahead, I think, with what plans people had.
Great. Thank you. If you're able to stay on, there may be
Sure.
some questions at the end, but definitely appreciate you being here. So you heard it here first, people. We're not in a recession. There's many opportunities available to you. Keep being strong. And with that, I'd like to hand it over to Dr. Ray Bowman, who is the director of the Small Business Development Center at Camarillo, but also covering Santa Barbara County as well. Ray, do you want me to share my screen, or do you have your slides up?
If you could go ahead and share screen.
Okay.
I just have a few slides.
All right, just bear with me 1 second. And oops. All right, so I'm going to click through to here. Over to you.
Great. So as was mentioned, I'm the director of the Small Business Development Center. Just real quick about us, we're an SBA program that provides technical assistance to small and medium-sized businesses. I'm the director that covers both Ventura and Santa Barbara County. So our center sees about 2,000 clients a year, close to that. We have 60 plus advisors with different types of technical expertise, and all of our services are free to the business. So, we're part of an SBA program that gives that technical assistance. And, we have clients that have been with us for, I started our program here, so it's about 12 years. And so we have a lot of long-term clients, a lot of small businesses that we're working with. Throughout the country, the SBDC program sees roughly about 2 million businesses. So it's kind of interesting because you get all kinds of real interesting insights into businesses. In the state of California, the SBDC program sees about 100,000 small businesses a year. And one of my roles, in addition to being a director of a small business development center, is I also have a data team that manages data for the 97 small business development centers that cover California. So in light of this conversation, I wanted to share a study that we did during the peak of the pandemic. And as much as we're getting, kind of in a different phase of the pandemic, we're kind of waning off that and looking at other challenges, I think there's some important lessons that we learned during that peak of the pandemic. So next slide. So we conducted a survey. So what we did was we reached out to all the SBDC clients, about 200,000 of them during the peak of the pandemic. And what we mean by peak was January of 2020 through July of 2020. And we were able to survey over 22,000 entrepreneurs. And it was great insights because these are companies we had already engaged with. We knew their demographics, we knew where they were. And so we could ask them some more detailed questions. So during that time, during that peak of that pandemic, 60% of those businesses were closed and remained closed through July. And then another 40% out of that 60 then returned to normalcy. However, there were still about a third that were closed or permanently shut down. And only 20% reducing operations during the initial crisis. So next slide. So some of our observations, and these are observations that are similar to some other studies that were done and along the lines of what was happening during the pandemic. So non-employers and the smallest, youngest firms, they struggled the most. So 45% non-employers, 28% of businesses less than 5 employees, and 42% of businesses with less than 2 years old had halted their operation. So the pandemic had a much stronger impact on these small businesses. And so many of the small businesses we encounter are within this category of business. Women and minority businesses, according to our survey, struggled more. They reported that they had a harder time during the recovery. The losses of revenue, the impact on their business operation was just greater within those 22,000 that we surveyed. As much as the PPP and EIDL helped a lot of businesses, and the implementation of it was unprecedented in the amount of funds that went out to small business, the alignment wasn't really perfect. In other words, you had close to a 50% chance of getting one of these loans if you were some kind of corporation, LLC, C Corp, S Corp. If you were a small business sole proprietor, it was somewhere under 5% chance of getting these loans. And then if you did get the loans, a lot of times it was misaligned. So the types of businesses who were impacted the most had less of a chance of getting these loans than other industries that weren't as impacted. And that's something we saw. Having said all that, though, what was really interesting about our survey was we saw this unprecedented rate of innovation. And there's all kinds of innovation. You know, we usually think of innovation as only being, you know, R&D activity, patents, but there's all kinds of different activities that fall under innovation. And we asked these companies, how did you innovate? And so roughly over 55% of those 22,000 said that they had innovated to adapt to the pandemic. So 40% innovated their product or service or process, 12% retained or upskilled their workers. So one of the things we find, and when you look at other surveys on innovation, this rate of innovation was extremely high during the pandemic. And when you think about it, there were a lot of businesses that didn't necessarily lose their customers, but they had to reconnect with them. They had to, you know, go online, put their businesses online. They had to figure out innovative ways to get to their customers, or they had to pivot from an existing product to a product that was in more demand. And so those rates of innovation were so great. It was really interesting. We often don't think about innovation as a survival skill, but it very much was during the pandemic. The next slide. So, you know, what are some survival recommendations that came out of that pandemic? And actually, these are recommendations going forward, is to have better alignment between financial assistance for those non-employers and young businesses and minority and women business owners. And where do you get that alignment? A lot of that comes from, you know, the support of various programs like Women's Economic Venture, the SBDC, SCORE. It's very important going forward to really network and get better connection to where are the sources of finance, where are the loan programs. So getting that word out is more important than ever, because we found that there were huge gaps, even with some of the grant programs, you know, that were put out through various communities. Getting that word out, the smaller businesses just weren't as connected. Increasing financial management training, and Gonzalo will chime in after me, and he can reinforce this. This is literally a recommendation that's 24/7 with us. As a small business, part of your survival is understanding your key metrics, how to manage, how does a dollar flow through your business. So it's really important to understand your finances and how to use those financial metrics to drive your business. And then encouraging innovation. Again, I don't think we stress enough how important innovation is to the survival of the business. But of those that we surveyed that said they innovated, very few of them had any lost revenues at all. Most maintained or actually increased their revenues, whereas the remainder of those we surveyed almost without exception declined. So we really have to focus on that. And again, innovation isn't necessarily doing something, some big R&D play. It can be as simple as saying, let's change our pricing. Let's change the way we find our customers, our processes, so those are things that are very affordable to a small business. And then again, we talk about the skill gaps. We've talked about inequity, but it's very real. It's very much out there. So I think we need to do a better job at reaching out to those communities that are underserved. So very much throughout our survey, those who got the resources were in pocketed areas, or pocketed communities. So it's very important that, when we have these types of programs that we really reach out to as large a community as possible. For those in those communities, networking is more important than ever. Those who are better networked got the services they need. And we saw that over and over again. Next slide. So I'm going to leave, sort of transition this to Gonzalo, who will talk about more the deep on the ground part of working with our small businesses. Just to lead into Gonzalo, he's one of our financial consultants, extensive banking and finance background, and so he could take this and bring this down the level down to the level of the business. So.
Thank you for this opportunity, Peter. Some interesting information that you share. That's very good. I like your opinion on recession. That's a buzzword that people picked up somewhere, and all of a sudden they use it for everything. I want to talk to you. My background, as Ray mentioned, is 50 years in the banking industry. I thought I'd retire when Ray approached me one day and says, "No, you're not going to retire." So I took another full-time job, I think. I'm not sure of that yet. During this crisis, and I determined the crisis, as you see in there, what happened during COVID-19, and followed by the supply chain events. The events that affect a small business. And what is a small business that I see? And I saw over that period of time, over 200 clients, okay, that came to us. And I will share with you what I found in those 200 clients that created serious problem for many of them. The average sales, $100,000 a year. That's nothing for a medium to large size business, but it's significant for a small restaurant somewhere in Ventura. Okay, that's a big number in sales for them. And I've seen up to $5 million in sales on larger manufacturing type companies. It's interesting that the omissions of one are reflected in the larger one. It's incredible how they do not pay attention to some of the things that I'm going to talk about in here. I want to reinforce something that Ray mentioned, is that reinventing yourself. Some people that own a business, they think that because they're making a reasonable return, which sometimes blows my mind, that 2-3% is a reasonable return, but that's okay. That's what they want to accept as a reasonable return. I tell somebody, I said, buy a government bond, sit at home, read the paper, and live with the interest. But that's not the case. You have to be an entrepreneur to dream that way. And so reinventing yourself, and you have to follow what the market is telling you. Your customer is the most valuable commodity for any business. Talk to those customers and follow the industry trends. Read about what's going on in your particular industry to see what the larger operators are doing. again, I repeat, what I found is people were not doing this. And unfortunately, I saw many businesses that lost their capital, they lost their business by not following what the foundation of what they need to do. They most of them totally dislike numbers. You have a small business operator using a restaurant as an example, they know how to cook, or they know how to attend clients. And you ask him about numbers, he says, oh no, that's taboo. I don't want to see numbers. I said, that's your money. Pay attention to your money. And so I tell them, I use something that is from Mr. Carroll that says, if you don't know where you're going, any road is going to take you there. And I cannot believe how many people I saw that had no idea where they were going. And do you have a financial plan? Do you have an operating plan? Oh, no, that's too cumbersome, too difficult. Doesn't have to be. You can write it in the back of the paper or the notebook. You don't have to have a very complicated financial plan, operation plan that you pay somebody $3,000 to write it for you. First of all, when they write it for you, you have no idea what goes on in there. It's better than you write it in your own words, but have one, sit down and write a financial and operating plan. Understand the contents of the financial statements. Okay, many come to me when I said, you have a balance sheet, and you see these blank stares at what? You don't have you have a system. No, I don't have a system. They're very inexpensive system these days that I don't care the size of your operation. You should take advantage of those. You have entities like Weave, or you have entities like SBDC that they can help you put those together. So understanding that and putting a plan together that tells you where do you want to go. And if you get out of that road, that's fine. At least you have the road, you know where to come back to it. Okay, what the financial statement, what's the purpose? Establish a protocol to review this financial performance. Some people, have a very common system is called QuickBooks. Yeah, I have QuickBooks. Do you look at it? Oh, no, well, I don't look at it. I says, why do you have it? Because the CPA asked me to get it. Okay, that's very good. But what does it do once a year when the CPA look at those statements and tells you, hey, guess what? You lost money. And it's not the right way to manage a business. You have to establish a frequency. What happened to your sales? Are they going up, down? They staying flat? I tell you what, there's a person that I have a great deal of respect, no longer with us, that ran Chrysler, Mr. Ayacoca, that said, if you're not moving up in sales, you're moving back, because somebody's taking those clients that will allow you to get those new revenue. Gross margins, extremely important. People don't pay attention to gross margin. Gross margin is your sales minus the cost of goods. You do not control the cost of goods. The cost of goods are impacted positively or negatively by the people that provide you the raw material that you need to produce what you sell. And you need to know, because that is going to impact your pricing. If that is going up, okay, you got to quickly find out how you're going to adjust your pricing. And you may say, well, in a couple of months, we'll come back down. Pay attention, not always come back down in a couple of months, okay? And then all of a sudden you find yourself, I have a classic example of a company, $2 million in sales, that I don't know how many times I told them, your cost of goods sold keep going up. Your margins are eroded, the gross margin. You need to increase pricing, okay? But they didn't pay attention to that. Then the operating margin, your expenses, break-even levels. Most people do not understand what is my break-even level. And the break-even level can be yearly, can be quarterly, can be monthly, okay? And you can even bring it to daily if you want. I don't think it makes much sense, but you need to understand what level of sales do you have to maintain, okay, to cover your fixed cost. And you can extend it further to cover all costs if you can establish a reasonable trend, an average of total cost from month to month. You know how to compare periods. What is a period? You determine what a representative period of your business is. Month, quarterly. I should not recommend any further than, you have to do it at least quarterly. And last but not least, when you tell the people cash flow, they say, what? Cash flow, that's how much money I have in the bank. I said, no, that's not how much money you have in the bank. So I need to explain cash flow. You need to understand to monitor the cash flow that you have that of your business. I added in here, which maybe might be a little bit too advanced for some people, but use common size financial statements. Okay, people try to compare dollars to dollars. No, it's because I use common size, which is percentages. What percentages of cost of goods sold are represented in the sale, which is your gross margin? Rent, what percentage of your rent is as a relationship to sales? And every one of those you should monitor. If it gets out of hand, immediately take action. I go to the next slide right now. Key questions to ask every day before you go home if you own a business, okay? And how much cash do I have? Something very simple. And they tell you, well, I have $1,000 in the bank. No, you do not have $1,000 in the bank. Look at your books. How many checks you wrote that have not cleared the bank yet? And then, oh, I don't have, I'm overdrawn. I said, yes, you are. Okay, so check your cash. Did I break even today? You should have a pretty good idea how many dollars of sales you have to generate every day to know if you broke even. Maybe daily might be a little bit too much for a business, but at least you should do that monthly. What is my balance in accounts receivable? Please, small business, you're not in the financing business. If somebody owes you money, they have to pay you. And the next day when you come back, you call those people. It says, hey, you owe me the money. Guess what they're going to tell you? The check is on the mail. Okay, well, you wait, you believe them. 2 days, the check doesn't arrive. Hey, Peter, what happened? I didn't get my check. Oh, I have it here in my drawer. I forgot to send it to you. I'm going to send it to you right now. No, Peter, 1 second. I'm going to drive. Well, I'm going to send somebody and I'm going to get my $1,000. That's your money. That's money that you needed to operate. In a small business, that's a big deal. Watch your accounts receivable. So those 3 things: how much money you have in the bank, do you break even, who owes you money is not paying you. Understanding pricing methodology and capacity utilization. I found many people that did not understand that. Okay, you need to monitor pricing. And some said to me, well, but if I increase prices, customers will go away. So what? You're losing money with them. What difference if they go away? Okay, and so you gotta check your pricing. I had a client that we made a bet. This particular client is in a service business, and they have not touched pricing for the last 3 years when we were talking about this. So you got to increase pricing tomorrow. I helped them prepare the letter to the customer. So what about if I lose them? The same explanation. You're losing money with them anyway. They lost 12 clients. And out of that, 8 came back again. But 8 came back at the right pricing. Okay, so in reality, and then a new client that came in, they came in at a new pricing. The gross margin immediately went up. Capacity utilization, particularly if you have a production type, manufacturing type facility. You have people, that's a fixed cost. When you pay people, it's a cost of good. And whether you have 1 widget that you're making or 100 widgets, okay, you're going to pay them the same thing. And so quite often, the volume of sales goes down and you don't realize the amount of money that you're spending in the back shop because the production is not what it's supposed to be. And if you don't monitor that, people tend to be a little relaxed, okay? I learned that several years ago in banking. I had a department that was heavy into production. It's called Lockbox. Doesn't mean probably anything to any of you, but some engineers that we hire, production engineers, proved to me, when the morning came in, we put a big pile in front of somebody, and they monitor how fast those individuals work when they had a big pile of paper in front of them to process. The next day, that pile was down to half. It took them the same amount of time to process a big pile than a medium-sized pile because the people adjust. Okay, so you have to supervise that. Efficiency of payroll expenses. Payroll, in most cases, is your biggest expense. Okay, so payroll, benefit, taxes, all that included. Okay, if you need to monitor sales to payroll expense and see how's it going. Quite often you will find, if you monitor that sales went down, but the payroll expense remained. So your sales to expense payroll expense ratio change. And you should set a target. I need to operate this business with that kind of a ratio. Debt management. Peter touched on that. Debt is a business killer. Debt is a business killer. I cannot reinforce that enough. You know, you have the tendency to say, oh, I like to borrow to do this and this and that. And I said, okay, if you're going to borrow X, what are the monthly payments? $500. Okay. How many dollars in sales do you have to, new dollars in sales, do you have to generate, pay for $500 and still keep your operating margin? They don't think about that. They just borrow the money and start paying $500 a month. And pretty soon they're going to be upside down because of that. They like to buy equipment. They like to buy this. Why? Why? Where is the return? Where is the return on that dollar that you're going to use? And managing positive net worth. See a lot of businesses, when you look at the balance sheet, liabilities are greater than assets. When liabilities are greater than assets, that means you have a negative net worth. And that is not a way to run a business. I don't mean that you need to accumulate tons of dollars in your net worth, although be careful, because if you want to expand tomorrow, a lender is going to come in and says, how much money are you going to put in? How much money is in your net worth? Oh, I don't have any. So you want me to put all the money for this expansion and you're going to put nothing in it? No, that's not the way it works. Okay, so be careful with that. That brings me to my last slide. If we move, okay. When I bet you, if I ask you to raise your hand, how many of you have a doctor, a medical doctor? Probably the majority will say, I have one. Why? Because if you have a cold, if you have this and that, you're going to see them. Okay, because you don't trust yourself diagnosing with a diagnosis of what you have. Well, in business, it's the same thing. Okay, when you have a business, get yourself a financial advisor. Ask him questions. In the case of WEVW and SBDC, it costs you nothing. Okay, it's there for you. Call them. Says, I want to check with you. I have a handful of clients that call me semi-financial statements, and we sit down every quarter to review the statements. Okay, and I give them my advice of what I think they ought to be looking for and what they ought to be doing. That's like a doctor. You go to a doctor at least probably twice a year to do a checkup. Well, do a checkup with your financial advisor or business advisor. This organization have more than just financial advisor like myself. They have legal, marketing, social media. They have a number of things that we can advise a business on. That's enough.
Thank you, Gonzalo. That was a lot of information. Actually, this whole hour has been a lot of information. But if I can summarize, we're in a time of economic uncertainty. I think we're going to always be in some kind of uncertainty at this rate. So it's incumbent upon you as entrepreneurs and business owners to help yourself to be successful. So innovating through listening to your customers, looking at the market, looking at the channels of sales that you have, and then really strengthening your financials, becoming very cognizant of things like digital marketing and e-commerce, just constantly paying attention to what's going on in your business. And the beauty of being in this area is that you have a lot of resources available to you, and the business owners that succeed are the ones that ask for help. And there is an amazing array of expertise that's available both through the EDC and through WEVW, whether it's working with an advisor on an individual basis or taking a training program in a specific area like digital marketing or finance. So I'm just going to quickly share my screen again. If anybody has any questions, please feel free to enter them into the Q&A box or into the chat. I'm not seeing anything at this moment, so I'm just going to keep moving forward. And just sharing more about the resources that we have within the EDC and within WEVW. So as Ray mentioned, please go ahead and, you know, make a note of the phone number and the link if you wanted to schedule time to speak with a business advisor there. The EDC is also a provider of funding. I'll take up Gonzalo on the debt management issue. I think, you know, the right kind of investment into a business to grow your business at the right interest rate with the right financial provider can really make a difference. But it's critical that you understand, A, whether you can afford that debt, and B, that you're using, you know, that you're accessing an interest rate that isn't going to upend you as a business owner. So again, EDC and WEVE are well placed to support with that. And there is the information to contact WEVE as well. Peter, I see you've come off of mute. Did you want to have a parting word?
Yeah, I do. I mean, I think WEVE, you know, everybody should realize what they're doing, what the EDC is doing. You know, it's fantastic. I just want to say that, you know, given these recent bank failures, and there'll be a lot of talk about regional banks. I think here in Santa Barbara, I also think individuals should reach out to the community banks. You know, they're strong and they know how to help. I mean, they're here, they know business better than the national banks. And so I think that's another form. And I'm sure that, you know, Ray, you know, Nikki, you guys, you know, work hand in hand with lots of the community banks, but they're our allies too. And I think that's something that, you know, we shouldn't forget.
That's an excellent point. And yeah, thank you for mentioning, Ray. I'll give you a chance. I do want to just say that there's a $250,000 federal guarantee on any deposit that's at an FDIC bank, and our local banks, you know, obviously check as a consumer, but they are all part of that. Ray, go ahead.
Well, one of the things I just wanted to mention, and thank you, Peter, for your insights. It just great presentation. But one of the things that sort of triggered my memory is when you look at all those recession points that was in one of Peter's graph. Yeah, there were a lot of businesses that were hurt during those times. But equally, I can tell you in each of those inflection points, we had a client that did extremely well. And I can name off clients that during those times, they knew what to do, they networked, they understood their financials, and they innovated, and they were able to turn things around. So, in fact, some of the strongest SBDC clients we have were founded during those inflection points that would have scared others. So, you know, I really want to emphasize the fact that there's some opportunity in these times that we consider, you know, down or dark, or money's harder to access. And a lot of companies that are founded during these times, they tend to manage their finances better just because, you know, resources are limited. And then I just wanted to point out too with Gonzalo, that whole concept of common sizing, understanding where a dollar goes, you know, for every dollar I make, how much of that is going to overhead, how much of that is going to payroll. And I can't emphasize enough how important that is and how simple it can be if you sit down with someone who can help you.
Yeah, great point, Ray, and a sound one to end on. So again, I just want to thank Peter Rupert, Dr. Ray Bowman, and Gonzalo Fernandez. I'd also like to thank Lena from Bridging Voices for providing the interpretation. My colleagues Ali and Tracy, who also helped with putting this webinar together. This is the first of hopefully many more collaborations with the EDC and other community partners. It's good to provide one voice out to the community in times like these. So thank you everybody for being here, and wishing you a dry rest of your day. Thank you.
Thanks, Nikki. Thanks, everybody.